Good morning. So I want us to do IAS 1, that is published financial statement. So IAS number 1, which is to be replaced with IFRS 18. Both of them can be used, but we shall use IAS 1. But if any other person use IFRS 18, which is still applicable, though it will be effective from 1st January 2027. But early adoption is allowed. So early adoption is allowed. So anyone who uses FRS 18 as an early adoption is also allowed. And those who are still using IS 1 is also still applicable, but IS 1 will cease to be used at from 1st January 2027. So after 1st January 2027, IFRS 18 will be adopted, and it will be the one which will be used, but IAS 1 will not be used. It will be discontinued. But at the moment, any student or any organization that uses IAS 1 or uses IFRS 18, both of them are still applicable. Both of them are still applicable. Reason why? Because IAS 1 is the one which is now, if it is not, it is the one which is effective today, and IFRS 18 is also still effective today because according to the IFRS, they say that early adoption is allowed, and therefore, even if we are not in 1st January 2027 onwards, IFRS 18 can still be applicable because early adoption is allowed. So you need to know that one at the moment. But for the class purpose, I'm going to use IAS number 1. That is International Accounting Standard number 1. Published financial statement and presentation of the financial statements. Good. Now, when we talk about the published statement, now these are the statements which are prepared for publication purposes. So when we talk about published financial statement, these are the statements which are prepared purposely for publication purpose, so as to allow the public to make informed decision from this statement. Now, the following statements or accounts are prepared. So we have the income statement or the profit and loss account, the P&L account. Then you have the statement of changes in equity. Then you have the statement of the financial position. Then you have the statement of cash flows. So all those statements are prepared and are published financial statement. Now, when we talk about the income statement, it tells us about the financial uh, it shows the overall net profit for the company. So we talk about the income statement. What does the income statement tell us? Income statement. Now, income statement, it is a statement which shows the overall net profit. It is a statement which shows the overall. It shows the overall net profits. Net profit during a particular period. Or you can say it is a statement. It's a statement which shows the financial performance of the organization. So a statement which shows the financial performance of the company. And remember, when we prepare the P&L, we need to consider these items. So we shall have four types of expenses. We shall have the cost of sales. And remember, cost of sales shall include the loss or disposal, and shall also include depreciation expense. So depreciation expense and the loss of disposal are included in the P&L, in the cost of sales. Then you have the administrative expense. These are the normal expense for the administrative purposes. Then you have the distribution expense such as commission, advertisement. Then you have the finance cost, that is the interest on loan, bank charges, and so on. So all those shall be categorized under finance cost. Now that's okay. Number two, we have the statement of changes in equity. Statement of changes in equity. Now this one shows the movement. So it's a statement which shows the movement of the shareholders fund. So is the statement. This is the statement which shows movement, shows the movement of the shareholders fund. So that's the statement which shows the movement of the shareholders fund. Statement of changes in equity. Then you have the statement of the financial position or the balance sheet. All this we don't need to write them down because you already know. So this is a statement which shows the financial position of the company at the end of the year or as at particular end of the period. Then we have the statement of cash flows. It's a statement which shows the movement of cash in and out of the organization. In and out of the organization. Let us see the format. We shall take a look on the format of the statement of P&L, statement of changes in equity, and the statement of the financial position. The cash flow is the same. The cash flow that we have been preparing is the same as the published. So those items will just be the same. So let's start with the statement of the income statement, the P&L. Now our P&L, let's say for example we have XYZ, statement of P&L, statement of profit and loss for the year ended. You put your date. Let's say that. Let's assume this is our date. 31st December 2024. Let's assume that's our date. Then in shillings amount, let's say it is in million. So we start with the revenue. So this is the format that we shall be using. Revenue. Then we less cost of sales. Then we get our gross profit. Then we add other income. Which are available. You can say investment income, for example. Investment income can be one of our example. Now we can list our expense. So we start with the admin expense. Administration expenses. Then distribution expense, my distribution cost. Distribution expense or the distribution cost. Then we get profit before interest and tax. So we get profit before interest and tax. Then you less the finance cost, that is the interest. Finance cost is our interest. So that we get profit before tax. Profit before tax. Then we less the income tax. Once we shall get the profit after tax. Profit after tax. Once we get our profit after tax, we add other comprehensive income. Add other comprehensive income. Comprehensive income, for example, of other comprehensive income is the revaluation gain. Revaluation gain. Revaluation gain, so that we can get total comprehensive income. Total comprehensive income. That is correct. So once we have the total comprehensive income, I think that one will be fine. That one will be fine. Uh-huh. Uh, uh, so let me show you statement of changes in equity. 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 This is how it looks like. Allow me to rub the board. Allow me to rub the board so that we can prepare the statement of changes in equity. So let's see the format of the statement of changes in equity. The statement of changes in equity, which you say is a statement which shows the movement of shareholders' fund. So we say XYZ statement of changes in equity. Other people call them the statement of changes in capital. It's the same thing. So you can find other examiner saying statement of changes in capital. So statement of changes in capital. Or other people use the statement of changes in capital. It's the same thing. So, and we say it is in million, for example. So we start with the particulars or the details. We start with the details. So we can have ordinary share capital. Ordinary share capital. Let me expand it a bit. Or I can expand it from this side. I hope up that point is fine. Ordinary share capital. We can also have a share premium. Share premium. You can have retained earnings. Retained earnings. We have revaluation reserve. Revaluation reserve. We have general reserve. General reserve. Then the final one is the totals. So that's how our format will look like when we talk about the statement of changes in equity. Then you can start with the first item. Our first item is the balance roll down as a control balance. So balance brought down as per trial balance. So balance brought down. But remember, it's as per the trial balance. So if we have the ordinary share capital, share premium. So this item you derive them, or the source of this item is from the trial balance. So the source of these items, it is from the trial balance. So the balance brought down as per the trial balance. So the balance brought down as per the trial balance. Then we check if there is issue of shares. Issue of shares. Now, if there is issue of shares, they can only affect the ordinary share capital account. The rest of the item will not be affected. So the issue of shares. So if the company issue shares in the period, it means that the ordinary share capital balance will increase. So you add them. So any issue of shares you add. Issue of share premium. So issue of shares, or let us say issue of ordinary shares. That's the issue of ordinary shares. Then you can also have issue of premium shares. Now, if we issue of premium shares, it means that our premium account will increase. So that we have the total together with the increase. So if it is issue of premium shares, then it will affect the premium shares account. Bonus or profit. Bonus or profit. So you can have bonus or profit which affects the ordinary share capital account. So bonus or shares, bonus or what we call profit, not profit, right issue. Let's talk about the right issue. And then we talk about the profit for the year. Profit for the year. Profit for the year affects the retained earnings account. So if it's a profit, you add. If it's a loss, you less. So profit or loss for the year, it can be profit stroke loss for the year. So that you have the total amount here. So I have said that the profit or loss affects the retained earnings. So if it is a profit, you add. If it is a loss, you deduct. If it's a loss, you can deduct. Dividend paid. Dividend paid affects our profit, our retained earnings, and therefore, when we pay, it reduces this account, so that we have our amount here paid. We have revaluation gain. Revaluation gain, which affects our revaluation reserve. This one. Then you have the total. Then you can have transfers to general reserve. Transfers to general reserve. Transfer to the general reserve, so it can be from ordinary share capital. Maybe, for example, we can be transferring amount from the ordinary share capital, and then we transfer it to our this account here. So when it moves from one account, we deduct, but when it go to the other amount, we add them back. Then the total will be 0. That is all. Then we shall have our balance carried down. Then we shall have the balance carried down. Balance carried down. Then we shall have our balance carried down. So balance carried down, total amount. So you add this plus this plus this minus this, get the final figure. You also add and less where appropriate. Then the total, you add them together. So remember, the first one was the balances from the total balance. So it's direct. Then issue of shares. issue of shares, share premium, then issue of share premium, then if we have bonus and the right issues, you also include profit for the year, if there was any dividend paid, if there was revaluation, and then if there was any transfer. Now for transfer, transfer can take in any form. It can be from the ordinary share capital to general reserve, or it can also be from share premium to general reserve. It can be also from the retained earnings to general reserve. And it can be from revaluation reserve to general reserve. So whichever the form. So for me, I have assumed from ordinary share capital to general reserve. That's the format that you need to know when preparing the statement of changes in equity. Now for the balance sheet, we shall do it in equation. For balance sheet is the same. What we have been doing, we need to follow the format of the non-current asset, current assets, equity, and the liabilities. So the format is the same. Let's go to the December 2021 question. It's the simplest question. So I have decided to start with the simplest question. December 2021, question number 5. December 2021, question number 5. December 2021, question number 5. Let me read the question, then we do it together. The question is about Bawabu Limited. So the question is about Bawabu Limited. So the fund of balance relates to the Bawabu Limited at 1st March 2021. So we have the trial balance there. You don't have to read the balances. Then additional information. So we have 4 additional information. Additional information number 1. On 1st April 2020, the directors of Bawabu Limited resolved that the financial statement would show an improved position if property was revalued to the market value. As at that date, an independent valuer valued the land at 160 million and the building at 485 million. The remaining life of the building as at that date was 25 years. Bawabu Limited does not make a transfer to retained earnings for excess depreciation. Ignore the deferred tax on revaluation surplus. Number 2, property and equipment is depreciated at a rate of 15% per annum using the reducing method. All the depreciation is charged to cost of sales, but none has yet been charged on any non-current assets as the year ended that 1st March 2021. So we need to adjust. But remember, all the depreciation is transferred to the cost of sales unless told otherwise. Bawadu Limited estimated an income tax provision of 113.8 million is required for the year ended at 1st March 2021. The balance on the current tax on the trial balance represent under or over provision of the tax liability for the year ended that 1st March 2020. As at that 1st March 2021, the tax base of Bawabu Limited net asset was 292 million less the carrying amount. The income tax rate is 30%. Number 4, Bawabu Limited made a 1-for-5 bonus issue on that 1st March 2021, which has not yet been recorded in the books of account. The company intended to utilize the share premium as far as possible in providing the bonus. So the bonus will be paid out of the share premium. So the bonus will be paid out of the share premium. So the bonus will be paid out of the share premium. So we are required to prepare the statement of profit and loss and the statement of the financial position. So in this case, there was no requirement for us to prepare the statement of changes in equity. There was no any requirement. So there was no any requirement for us to prepare the statement of changes in equity. So let us do this question together. Let's do it together. So there was no requirement for the statement of changes in equity, so we shall not prepare it. So let us try that question together. The question is for the December 2021. December 2021. The question is question number 5. I had already did the necessary by reading the question. So for now, it's for us to do it together. So let's start with additional information number one. Additional information number one. Additional information number one is about revaluation. So on 1st April, the directors of Boab Limited resolved that the financial statement would show an improved position if the property were revalued to the market value. On that date, an independent valuer valued the land and at 160 million and the building at 148. So let us start with that one. So there was a revaluation of land and the building. So let's say this is working number one. So land and building, all these amount are in thousand. So let us start with the revalued amount. Revalued amount. Then I need to push this one a bit. So land, then building. So land was revalued to 160 million. And then building to 485 million. So that one is in thousand. Now let's see the value in our balance. The value as per our balance or the net book value. Net book value. And remember net book value. Net book value is equal to cost minus accumulated depreciation. So remember, net book value is the cost minus accumulated depreciation. Let's start with the one for land. Now land does not do what? Land does not depreciate, so it was 146 million. There no depreciation, so that is in our balance. If you go to our balance and you check property at cost include land of 146 million. So property at cost include land of land 146, and then we have building. Where is the building? Building. No, the building is the property. Removing the land now. So we remove the land now. So remember, land is 146. The net book value 1000. But remember, this one is inclusive of building. So for building, which is the property, we need to deduct this amount for land. So the total amount for building is 732,000. 732,000. Just in our balance, check. But it is under something called property. Property. So property at cost 732,000. Then we remove the land. This land of 146 because we have already, that is under land. Then we deduct now the accumulated depreciation for the property. Let us say the accumulated depreciation for the property or for the building, it is 122,000. 122,000. So remember, you take the cost minus accumulated depreciation. So remember, this one is in cost. So remember, the figures are in cost. That's why we are deducting, because the figures are in cost. If the figures are not in cost, we could use a different working. But because they are in cost, so we don't take the cost amount less the accumulated. But remember, for building, this cost of 732 is inclusive of land. So this land 146, so it is already inside. So we need to remove it so that we remain with the building alone. Then we get, so once we remove the cost of land, then we remain with the cost of the building alone. Then we can deduct our depreciation, accumulated depreciation. So 732 minus 146, then we minus 122. We are getting 464,000. 464,000. So 464,000. Now we need to check if it is a revaluation gain or a revaluation loss. Now from our figure, it was 146. Now it is 160. Is it a gain or a loss? It has increased. So we have a revaluation gain. Revaluation gain. So it was 146 to 160. So how much is that? So it increased from 146 to 160. So how much is the gain? The gain is 14 million. It also increased from 464 to 485, 21,000. So we can have the total revaluation gain, by adding the two. So 14 plus 21, 35 million. Remember it's in thousand. So that is 35,000. So that is information number one. Still under information number one. The remaining life of the building as at that date was 25 years. The buyer does not make any transfers to the retained earning for the excess depreciation. So ignore the tax evaluation. So that's why I need to calculate that one. So say under information number one, depreciation for building. Now depreciation, it will be equal to. So we are going to assume that they are using the straight line method. The remaining life of the building was 25 years. So 25 years, meaning the most applicable amount there is 25. So as at that date, moving forward, the company will depreciate their asset on a certain basis for 25 years. So we take the value as at that point. That was the cost. Sorry, we take the cost. The cost of building as at that time, the revalued amount. So how much was the revalued amount at that point? The revalued amount was this one, 485. So it will be 485,000. We minus any scrap value which we don't have. Then we divide by 25 years. So that is the most applicable because we are talking about years, 25 years. We use the straight line method. So 485 minus 0 divided by 25 is 19,400. So that is the depreciation for that amount, for that building. So this one is for building. So remember, this one is the depreciation for the building. Then got information number two, or the working number two. Working two. No, working two is about property, plant and equipment is depreciated at a rate of 15% using the reducing method. All the depreciation is charged to the cost of sales, but not yet has been charged to any non-current asset at that year. So 25%, 15%. So depreciation for PPE, for property and equipment, they are talking about 15% on the reducing balance. Now let's go to the trial balance. Let's take the property and equipment. So property and equipment was 427,000. 427,000. But remember the reducing balance method. Remember the reducing balance method, so that we go to 2021, so that we get the depreciation for 2021 for that year, for that period that we are preparing, because this 427 is for 2020. So 427 is for 2020, but we need to get the depreciation for 2021. So we need to less the accumulated depreciation. So remember the reducing balance. For reducing balance, it is usually depreciation for reducing balance equals to percentage times cost minus depreciation. Cost minus depreciation. Now, we can talk about the accumulated depreciation in this case. So the only accumulated depreciation that we have in that case for plant and equipment is 85,400. 85,400. Then we get the figure. The figure will be equal to 427 minus 85,400. That times 0.15. This one is 51 to 40. That is the depreciation for equipment. That's the depreciation for equipment. Remember, this one is not been charged in the income statement, so we need to charge it later. We shall be preparing our statement. Then information number 3 is about income tax. Before we even read that information, let me give you a formula here. That is working number 3. Working number 3, income tax. Income tax is equals to current tax plus or minus increase or decrease in deferred tax allow me to do away with this one, and then we can also check, we can add tax under provincial, then we have tax over provision, so we need to know this working, now. So let us see the information now. Bawab Limited estimate that the income tax provincial of 113.8 is required for the year ended that 1st March 2018. That 1st March 2018. So we have a provision of 113,800. Okay. So that is the current tax. So the provincial is the current tax. So the Bawab Limited estimate that the income tax provincial, so that will be our income tax or the current tax. So our current tax is equal to 113,800 in million, because our figure we are putting them in million. Then we continue. The balance on the current tax in the balance can represent either over or under provincial. So let us go to our balance and check. Let's go to our balance and check if it's under or over provincial. So let's go to our income tax. So the current tax in our balance. So current tax in our balance. Into a balance. So how much? So the current tax into a balance can either be under or over provincial. Now, what is the amount? So the amount of current tax in the balance is 12,800, which is on the what? It is on the credit side of the. It is on the what? Credit side of the. Yes, it is on the credit side of the trial balance. So this one is on the credit side of the trial balance. Remember, it's on the credit side of the trial balance. Now, this is what you need to know. Then, before we continue, let me tell you this now. Now, current tax can either be over the current tax in the trial balance. So the current tax in trial balance can either be over provincial or it can be under provincial. So it is over provincial if it is on the credit side. So it's an income. In short, it's an income to the company. Or it can be on the debit side as an expense on the trial balance. So in this case, in our question here, the 12,800 is on the credit side. It is on the credit side of the trial balance. And therefore, if it is on the credit side of the trial balance, it means it is over provincial. It is over provincial. And therefore, if it is over provincial, we need to deduct this amount. So if it's over provincial, we need to deduct that amount. But if it is under provincial, it means we understated our tax and therefore we need to pay. So we need to pay. But if it's over provincial, we already paid excess and therefore we use this excess amount to reduce our tax. Now let us see now. So we have this figure. We have our current tax. Then we need to check the deferred tax. So let us do a working for the deferred tax. So remember, deferred tax is the carrying amount you left there. carrying amount you less the tax base. Now let's go to our additional information. We continue with the deferred tax. As at that first, at information number 3, the third paragraph. As at 1st March 2021, the tax base of Bawabu Limited net asset was 292 less the carrying amount. So meaning that the carrying amount was more than the tax base. According to that information of how much? 292 million. So in thousand, let me put it in thousand because our question is in thousand, 292,000. So 292 million, but we put it in thousand because of in thousand there. So the tax base of the net asset of 292 less the carrying amount. So meaning the carrying amount was more than tax base. What did we say about when carrying amount is more than the tax base? So when the carrying amount is more than the tax base, we shall have what we call the taxable deferred tax. So taxable deferred tax. So let's calculate the deferred tax. So deferred tax is equal to 30% of the difference between the carrying amount minus the tax base. So remember we said deferred tax is equals to temporary difference times the tax rate. But remember we said that the deferred temporary difference is equal to carrying amount minus the tax base. Carrying amount minus the tax base. That is correct. So times 30%, how much is that? How much is that? So 0.3 times 292,000. So 87,600. Now compare this one with the one in the trial balance. So what is our deferred tax in our trial balance? In our trial balance, we are in trial balance. In trial balance, we have a deferred tax of how much? So in our trial balance, I can see we have a deferred tax of 97,600. 97,600, which the difference is 10,000. Now we have an increase. We have a decrease actually, because it was 97. Now it is 10,000. So we have a decrease. So a decrease we deduct. So a decrease we deduct, and an increase we add. So in this case, we have it was in the balance it was 97,600, and now it is 87,600. So we have it has reduced from 97,600 from our balance up to 87,600. So it has reduced by 10,000. So we have a decrease in deferred tax. So decrease in deferred tax we deduct. Decrease in deferred tax we deduct of 10,000. So let us calculate now our income tax. Income tax. It will be the 113,800. We less the 10,000, which is we have said is a reduction, and also we less the over provincial, because we said that the 12,800 will represent our an over provincial. So we already paid an excess, so we use that amount to reduce our tax. So 113,800 minus 10,000 minus 12,800. I'm getting 91,000. 91,000. 91. I think that is the last working. So that's the income tax. That is the income tax. Now I think the last we have another one. Bonus. You can do it here. We have a bonus. We have a bonus. So I want to ratio so that the space be enough. Now, Bawabu Limited issued one for 5. So for every 5 share held, so this means for every 5 shares held, we get 1 share. We get 1 share. Now, let us go to our trial balance. Now, if you go to a total balance, we check the share capital. The total share capital was 160. So total capital, the total balance, that is the equity, it was 160,000, which is in million. Remember, it is in million. So it's about 560 million, but I'm putting 560,000 because our figure is in thousand. So let us get the number of shares. So number of shares, remember how to get number of shares from that account. It is 560 total capital. We divide the par value. Our par value from the total balance. Our par value from the first in our total balance, the first item, the ordinary share capital, it is 10 per share. So this one is 56,000. So for every 5, you get 1. What about if you have 56,000 shares in million? So you can multiply. So it will be 56,000 times 1 divided by 5. You shall get an extra share. And remember, these are bonus. So bonus are free. You don't pay for them. So the company will incur the cost of that amount. So 112,000. 11,200. Sorry, 11,200. Now, how much will be the total bonus? So let us see total bonus in cash or in amount. Total bonus, it will be the total number of shares times the par value, which is 112,000. So this 112,000, the shareholders will be given for free because it's a bonus. A bonus is a free transfer of shares to the members. Now, how will they? Because the shareholders are not paying for these shares. Who will be paying? Let's go back to our information so that we see. Because bonus is free, the company must pay this bonus by giving them freely to the members. So let us see who will be paying this amount. The company information number 4, the last statement. The company intends to utilize the share premium as far as possible in providing this bonus. So the share premium will be utilized. So let's say the share premium amount is how much? Share premium. Share premium in our balance is 160,000. It is 160,000. So 160,000 we deduct 112,000 because we shall pay this bonus from this account, share premium. So if the company pays this amount of 12,000 from our share premium, what will be the balance? How much will remain? So we shall remain with 48 million in our share premium. 48 million. Then once they have deducted the share premium, they shall transfer this amount to ordinary share capital. Let us say ordinary share capital account. It was 560,000. Now we add 112 because it shall be paid from the share premium. So we deduct the amount from share premium, then we transfer it to ordinary share capital account. Let me write in full. Ordinary share capital account. How much? 560 plus 112. 672,000. 672,000. 672,000. I think once we have that one, we can come up with a statement of allocation. Statement of allocation of expenses. So statement of allocation of expenses, we need to prepare it. Statement of allocation of expenses. Then once we are done with the statement of allocation, then we can prepare our income statement and the balance sheet. So statement of allocation of expenses, I think I can do it here. Statement of allocation of expense allocation. So we have the details. So cost of sales, naandika COS. COS means cost of sales. So we have 3 types of expense. 4 types. We said under public statement we have 4 types of expense. We have the cost of sales, we have the finance cost, we have the admin cost, and the distribution cost. We talk about admin cost, admin cost, we have distribution cost, and we have the finance cost in that order. Sorry. So we start with the balance breakdown. So the balance as part of the trial balance. So the balances as at the trial balance. So let's go to our trial balance. Let us see the cost of sales. Cost of sales is 164,700. Is it 164? Where is it? Cost of sales is 2,006,900. 2,006,900. That is the cost of sales. Then you have the admin expense. Admin expense is 201,300. 201. This is from the trial balance. So the balance brought down as per the trial balance. So the balance brought down as per the trial balance. Then we have the distribution cost of 164,700. 164,700. And then we have the finance cost. The finance cost in this case is the bank interest. The last one, 10,980. The last item, 10,980. Then once we have it, we add depreciation. So we need to add the depreciation. So we say depreciation affects which account? Depreciation affects the cost of sales account. So let's say the depreciation. So we add this one, 19,400. 19,400 plus 51 to 40 plus 51 to 40. I think those are the only depreciation we have. So we add them together. So this one is supposed to be, add the two so that we get our depreciation here. 19,400 plus 51 to 40. 70, 640. Now there was no admin expense, nothing. Yeah. Any other item which affects this account, we do not have any. From our additional information, we have worked all the additional information, and there is nothing which affects the cost of sales. Apart from the depreciation, there is nothing else which affects this account. Let's see the balance carried down. 10,980, 164, 700, 201, 300, and then the last one, 2006, 900 plus 70, 640. Then it's 2077, 540. 2077, 540. Once we have that one, now we can prepare our income statement. Our income statement, then the statement of the financial position. So I think we shall compress this account. So let us say Bawabu Limited. So we say Bawabu Limited. Statement of profit and loss. Statement of profit and loss for the year ended. For the year ended 31st March 2021. And then the last part will be for this other part will be for the balance sheet. The other part will be for the balance sheet. I hope the balance sheet will be enough to fit on that point. So we shall need to compress. So let's start with the revenue. So start with the revenue. So remember the account is in thousand. So revenue. So the revenue in our case, if we go back to our balance, total revenue is 27,79,160. 2779 160. Then we less cost of sales. Cost of sales, we have it here, 27,540. 27,540. So once we have it, we can get our gross profit. Get our gross profits. Let us see the difference. 2779 160 minus answer 701 701 620. Then let us check if we have other incomes. Do we have incomes? In this case, we don't have any income. In that case, so no any income, so we less expenses. So let us less expense. So we less expense. So we can start with the first one, the admin cost. The admin cost. Admin cost in this case is 201,300. We also have the distribution cost. Distribution cost. Distribution cost is 164. 164,700. So that we can get profit before interest and tax. Profit before interest and tax. Before interest and tax. So profit before interest and tax, how much is that? We deduct profit before interest and tax. So it is 701 620 minus 201,300 minus 164 700. So this is 335 620. 335 620. Then after that one, now we can less our interest. So we less interest, less finance cost, which is our bank interest, 10,980. So that we get profit before tax. So minus 10,980, we are getting 324,640. 324,640. So profit before tax. Before tax. So 324,640. Then less income tax. We have it here. Less our income tax here of 91 million. So we have it here. Our income tax, we have computed it, 91 million. So income tax. So less income tax, 91 million. So that we get the net profit or the profit after tax. So minus 91,000, 233,640. 233,640. And that one we can call it profit after tax. Profit after tax. Then once we have the profit after tax, we can less dividend paid. Less dividend paid. Because we are not preparing the statement of changes in equity. Now from this point here, this point, let me put it here, from the profit after tax downwards, it is our compressed statement of changes in equity. So because the question did not require us to prepare the statement of changes in equity, so we can use this version, compressed version, because there was no requirement. Now what's dividend paid? Dividend paid is 24,400. We can go back to our question. 24,400. 24,400. We deduct it. Then we add the retained earnings. So we we add retained earnings, retained earnings. So we add the retained earnings, balance brought down, balance brought down. So once we add it, we shall get the retained earnings. So let's see first. So let's go to our balance. We say the retained earnings at the beginning. Let's go to our question. The retained earnings at 1st April 2020 was 241,560. 241,560. So remember, this one is supposed to deduct the dividend paid because we are paying, so that we can have the retained earnings balance carried down. So we can have retained earnings balance carried down, retained earnings balance carried down. So how much? So we take 233,640 minus 224,400 plus 241,560 for 5,800. So I'm getting for 5,800. Then the last item, now we need to add the revaluation gain to get add revaluation gain, this one, that 5,000, so that we get the total comprehensive income. Total comprehensive income. Total comprehensive income. So that we get the total. We get the total comprehensive income. Total comprehensive income. So for 5,800 plus 35,000, 485,800. 485,800. So we are remaining with the last part. And the last part is the balance sheet. The last part is the balance sheet. Let us do the balance sheet with the shortest time possible. Balance sheet. So the balance sheet will be done in the other side of this question, of this board. So the remaining part. Good. So we say Bawabu Limited, settlement of the financial position. So Bawabu Limited, statement of financial position, as at 1st March 2021. So remember, it is in thousand. So we start with the non-current asset. Non-current assets. So remember, for expenses, the only expense that is available is this. So the examiner will be looking for cost of sales, admin cost, expense cost, and finance cost, and maybe the total comprehensive income. But up to this point, and the income tax. The only 4, 1, 2, 3, 4, 5, only 5. So let's start with the non-current assets. We start number 1 with PP, property, plant and equipment. Property, plant and equipment. Property, plant and equipment as a full amount. So property, plant and equipment, including land. So including land. So we start with the land. Let me just do a working here. Then we shall deduct. So how much was the land? Land was, it was divided to 60 million. And then what was the value of building? Building, remember building, we had a depreciation. So we need to check for that depreciation of this one for that year, 19,400. So we need to check that one. So we say building was 485. It was referred to 485,000. But remember to deduct. 19,400. So that how much would that be? 465,600 when you deduct. Then we had another one, PPE, property plant and equipment. Plant. How much was plant? Plant, we did a working for plant somewhere. That one. How much was that? 427. Supposed to be 427,000 minus accumulated depreciation of 85,400 minus now depreciation for the year 51 to 40. How much is that? And to 90, 360. When you deduct, you get to 90, 360. Then you add the two so that you get the property, plant, and equipment total. So that amount will be coming here as our PPE. So we need to, so you remember in property settlement account, there's like land alone, building alone. So we combine them together to form property, plant, and equipment as a whole. So we add them together. So 160,000 plus 465,600 plus 290, 360. 915, 960. So that is 915. 915, 960. I think that one is correct. 915, 915, 960. Number two, current assets. Current assets. Now, current assets, you can start with the inventory because we have it. So, inventory, what's the value of the inventory? Now, in our the value of the inventory. Inventory. 324,500. So the value, that is the value at the end. So they're saying that the inventory as at that first March 2021 was 324,500. So that is the value at the end. 324,500. That first March. So that's at the end of the year. So there was no any adjustment for that. Receivables. The value of the trade receivables. It will be 469,700 in the total balance because there was no any adjustments. So there was no any adjustments in our additional information, like the bad debt. There was no any adjustment. So in that case, the receivables is 469,700. 469,700. 469,700. 469,700. Now we can get our total assets. So total assets. Total assets. So when we add them together, 1710, 160. 1710, confirm. The 1710, 160. Can also confirm. And then 1710, 160. Then equity and liabilities. Equity and liabilities. So we start with the equity component. So ordinary share capital. Ordinary share capital. So our ordinary share capital, we have it here, 672,000. We have it here, 672,000. 672,000. Then we have share premium. Where is that? Allow me to wrap this part. We also have share premium. Share premium. Share premium from our working was 48 million. 48 million. Do we have anything else from the equity component? Retained earnings. So we have the retained earnings. Retained earnings balance carried down. So retained earnings. Retained earnings. Balance brought down. Balance carried down, sorry. So balance carried down is for 5,800. For 5,800, we have it there. We have it here. So the retained earnings balance carried down is for 5,800. Then you have the revaluation reserve or the gain of that 5,000. Revaluation gain. We'll go to the revaluation reserve. Revaluation. Do you have revaluation reserve actually at the big in our balance? So in our balance, we did not have the revaluation reserve, but we shall have it now because of the 5,000. So the 5,000 will be transferred to the revaluation reserve. 5,000. So we shall be transferred there as our final figure. Do we have any other item from equity? No. We go to non-current assets. Non-current liabilities. Non-current liabilities. Non-current liabilities. It is a deferred tax now. Deferred tax. 30% of the 292,000. 292,000. Which was giving us how much? 87,600. That will be our new deferred tax. 87,600. So that is our new one. So the initial deferred tax was 97,000 from the previous period, but it reduced from 97 to 87,600. Here it is 87,600. Then we have the current tax. Current tax. Our current tax of how much? What will be our current tax? Let's go to our additional information. Our additional information, we have okay, this one is supposed to be, this current tax supposed to be current liability. It's supposed to be current liability. So let's go to current liability. Liabilities. So payables. Payables. Bank overdraft. Bank overdraft. So a bank overdraft. Then you have the current tax. Do you have anything else? I think we don't have. So our bank overdraft from the question. Our bank overdraft from the question. It is 43,100. 43,100. Payables. Payables is 259,860. 259,860. Then the last item is supposed to be current tax. So what's our current tax? current tax. Current tax. So what will be our current tax in this case? The current tax is 113,800. Our current tax in the here it is. Our current tax will be 113,800. So we have our current tax there, 113,800. So that when you add, you get the total equity and liabilities. Total equity and liabilities. Which is supposed to be the same amount, 1710, 160. So confirm 1710, 160. 1710, 160. If you add them together, so 672, 48, 450, 450 what 800, 35, 87, 600, 259, 860, 43, 100, 113, 800, 1710, 160. So that is all for this question. It was the easiest one because it did not have a lot of information. So this question did not have a lot of information. We shall look for another question where we have other items inside. But for now, that is how you are supposed to prepare the published statement. So the next question we shall do, I will do the one with a requirement to do the statement of changes in equity. The statement of changes in equity. So let us meet in our next class.